Good morning, everyone. Welcome to BodhiBrew, offering advantage through insight. I'm your host, Confidie Kong, Creative Director of Bodhi Research Group. In today's episode, we cover Legends Lounge with Jim Keohane, the former President and CEO of Healthcare of Ontario Pension Plan, and our founder and CEO, Dr. Ranjan Bhaduri. Jim Keohane was the President and CEO of Hoop from 2011 until his recent retirement in March 2020. He joined Hoop in 1999, bringing more than 25 years of institutional investing experience with several national firms. So sit back, relax, and enjoy a cup of brew with us.
Welcome, everybody, to a special episode of BodhiBrew Legends Lounge with Jim. And I can't say enough good things about Jim. And everybody knows that he did fantastic work at Hoop. And I'm going to actually start with a personal story before we dive right in. My late father spent the last 16 days of his life at General Hospital of Hamilton. And I will never, ever forget the excellent work that the nurses did. And it was really a big comfort to my father and to my family. And I think that, this really goes to what Hoop does, is that they're providing pensions to the retired healthcare force, the nurses included. And they've done a phenomenal job. And Jim, the culture, I think, that comes from leadership, if you could talk a little bit about that, that would be great to start.
Okay. Well, thanks, Ranjan, and thanks for having me here. It's fantastic to be here. Real pleasure. So, I always thought that was critically important that people connect the dots between what they're doing and who they're doing it for. And, I think it's easy when you're running an investment portfolio to just think that it's about markets. Well, it's not about markets. It's about delivering pensions to those healthcare workers in Ontario who do a fantastic job for all of us. And so, it was a really important to me to connect those two things. And really Hoop is not an investment organization. It's a pension fund delivery organization. So the portfolio exists for the purpose of paying pensions. And I think it's really important for people to, again, to connect what you're doing with what the outcome is you're trying to achieve. And so the way I did that a lot of times, I would just, at all our town halls and things, I would read testimonials from members. And some of them are really tear-jerkers, but they really made you realize how important it was and what a huge difference it made in people's lives. And that's the whole thing. I mean, great organizations think what they do is they make a difference in people's lives. And if you focus on that, other things will fall out of that. So
absolutely. I mean, I and it was very evident in my dealings with Hoop, and I think it speaks a lot to your leadership and the culture that you created and that continues today. I want to also ask you about the fact that, it's not so long ago that you were CEO at Hoop and you had to deal with boards, and now you're on the other side, you're a director, and what it takes, to be a good director, that interplay, you have a special vantage having been on both sides.
Well, see, now that I'm on the board side, I have a much more favorable view of boards. But no, I think it's important, I think, to bring your experience to the table and, try and influence what people do as opposed to tell them what to do. And I think it's important as a board member, remember, you're not the CEO, which to me was a bit hard at first because you're used to being the CEO. They'll do things that maybe I wouldn't do, and it doesn't mean it's wrong. It just means it's they may have a different view on things than I might have. So it's which is okay. I mean, it's but I think it's important to again bring the depth of your experience to the table and try to help people understand why you want to do one thing versus another, and coach and mentor, I guess, is another part of the role.
So no, that's very fair. And so from a governance perspective, where is that calibrated line in terms of, from a director, you're not making the decision, like you're not the CEO, but then you're having to sort of guide, as you say, and give counsel. How do you calibrate that, and how do you view from the CEO seat and the executive team at a pension versus the directors?
So, I think a lot of it has to do with, was the proper governance followed? Was the proper risk processes followed? And I think if you're comfortable that good processes were followed, proper risks investigations were done, people really thought about the risk-return trade-off on things. But then, again, it's difficult sitting in a director's chair to make a decision on an investment because you're not party to all the due diligence that went on. And it's, you kind of get handed a piece of paper and you have 30 minutes to read it and you're supposed to make a decision on something. So, I mean, it's really hard to do that. I mean, but what you can do is look at, were all the risks considered properly? Have the outcomes been taken into account? But risks also include things like publicity risk or things like that you're not going to fall into a hole that you didn't do it by accident. And so, and again, I think that sort of experience and wisdom is something that you can bring to the table. So it's not about trying to second guess investments. It's making sure that the proper due diligence and risk assessment was done.
That's excellent. No, that's it's definitely true. And I'm going to pivot to some of those kinds of investments, because during your tenure at Hoop, there was an excellent track record of some very big deals that were calculated risks. And I like to say it's not a calculated risk unless you do the calculation, right? So yeah. It's amazing how there are some investments that don't seem to have the proper rigor. But what is what are some of the insights and nuggets of wisdom that you can share with the audience about deal making?
So, I mean, a lot of it is just, some of these things may sound like back of the envelope things, and they are a bit, but it's, again, trying to understand risk-return trade-offs on things. So, and what you're trying to find is situations where the risk is very low and the return outcome is very high. And so there's lots of things you can get into where you can actually sort of figure that out and calculate it, and those are ideal. I mean, some things are not that straightforward, but some things are. And I'll give you an example would be, corporate credit. I mean, you can look at it and corporate credit's reflecting the market's perception of default risk. So default risk, if you actually look at it over time, doesn't change by much, and it's reasonably predictable. But the market's perception of default risk can change a lot. So, and an example, if you go back to 2008, I think the market was pricing in a default risk of something like 30%, 30% probability of default. And if you go back to the worst case scenario you can find in the market before that was 1987 and 92, when the actual default rate was about 5%, the loss was about 3%. So the market was already pricing in something that was 10 times worse than that. And so, the odds of that happening is remote. So that was a situation where you were getting paid a lot for something that was for a scenario that's not likely to happen. So that's an example where you would try, go in there in a big way.
The sizing then matters, right?
Yeah, the sizing does matter. I mean, and other times if it's more neutral on that, and actually before that, the interesting enough, the market was not even pricing in a single default. So before 87, we actually were short credit because the pricing was crazy on the other side, and then it went so extreme the other way. We went way overweight credit, and those kind of extremes don't happen very often, but they do sometimes. And so if you have sort of a model of why you would do something at different points in time, when it does happen, you can get in there and take a stand on something. So it's again, it's looking at the risk-return trade-offs. They can be really good or really bad, and you act accordingly.
No, absolutely. The upside, downside, spoken like a true trader. And you mentioned 1987, which was, you were in the markets at that time even.
Yep.
And if you can just speak a little bit about some of these extreme events in 87, 08, like you've...
Well, I'll tell you a story about that. So I was working at Wood Gundy at the time, and I was essentially making markets and stocks to institutional traders. So we had a book we passed around the world at night. So, I'd say, okay, I'll buy or sell 50,000 shares of CP or something. So I got a call in the middle of the night, which I almost never got a call in the middle of the night. So I got a call in the middle of the night, a guy from London saying, I got a client that wants to sell CP, says he likes your price but not your size. And I said, well, what does he want? And he goes, I said, what's the market? And it was already down like $3 or something from the previous close, right? And I said, okay. And I bid $1 down from that. And the guy hit me. So I'm thinking, I'm in big trouble, right? I mean, so when you bid to miss and somebody sells it to you, you know you're in trouble. So that was a big learning for me. And the market went down 25% that day. So it was it was a real eye opener on risk. I mean, it's taught me no matter how bad you think it is, it can get worse. Mm-hmm. And so it was a real big learning experience.
I still remember August of 2007 for the quant managers, and then obviously 2008, the great financial crisis. And I mean, I sometimes feel like in 2008, instead of gaining 1 year of experience, it's sort of like dog years. I gained 7 years of experience, because those extreme events are really those outliers. There's so much happening, and you wind up learning a lot. But also in these extreme events, fortunes are made and lost. Yep. And it's public information from the annual reports that like Hoop made a lot of money in 2008, it capitalized on some certain deals, and you spoke a little bit about that now. That was also possible because of the liquidity management. Maybe you could say a few words about liquidity.
Sure. I mean, Hoop in particular, Hoop is running a lot of derivative strategies. So when you run a derivative strategy, you get margin calls, right? So, so the Achilles heel of those strategies, I mean, those strategies generally allowed us to actually reduce risk very materially in the portfolio by better matching assets to liabilities. But the Achilles heel is you've got to meet margin calls because you're using we have a very extensive use of derivatives. So it was really sort of front and center with us in terms of what we need to do to make sure we manage liquidity. So I always had a big liquidity buffer. And, because of that, as you say, I mean, in a crisis, it's two sides to the coin, right? Which is that if you're a liquidity seeker in a crisis, that's a really bad thing, because you're trying to sell into a down market, and, which is not a place you want to be. I mean, you can turn a bad year into a terrible year if that's a position you put yourself in. Whereas if you're the liquidity provider, I mean, you can buy assets at prices that you probably never thought you could buy them at, and that could make your returns for the next 5 or 10 years. And that's really what happened in 2008, was that we were able to buy provincial bonds at huge spreads to Canada, for example, just because people needed to sell.
Yes.
And we had liquidity to buy. So that actually served us extremely well. And the liquidity management is a big thing. So Hoop essentially had a treasury function. I mean, we didn't call it that, but that's really what it was. And so people that really did a lot of cash management, securities lending and borrowing. So we actually had a lot of expertise in treasury management expertise that most funds would not have. So if you want to have a portfolio structured the way Hoop was structured, you really have to have that expertise at the table.
No, absolutely. I mean, that's something that those familiar with Hoop, even from the outside, know that it's been a very innovative and forward-thinking pension, and largely due to the culture that you brought in and has been continued. And liquidity management, even today in general, is mismanaged often. I remember pre the great financial crisis, I did a lot of work on liquidity, and I published several papers on the value of liquidity. And from a behavioral finance perspectives, as human beings, we tend to underestimate the value of liquidity. Yes. It's just the way our brains are wired. And it's amazing to me how this is continued with certain portfolios and certain plans. But just it's really good to see the other side of it when it's really well managed.
Well, I used to laugh when people would talk about cash drag.
Yeah.
And I'm thinking to myself, well, that exactly what you just said. I mean, at different points in time, that liquidity is extremely valuable.
Yes.
And it's hard to know when that is going to be. but when it happens, you know it. And so be able to tap into a large pool of liquidity at any given point in time can enhance your returns tremendously. So whatever drag you have by having cash at points in time can pay for itself many times over in a crisis situation.
It's the optionality, right? Like, and then you have that optionality, and you're like the tiger or the lion waiting in the bushes. So you can make fortunes at those times. I still, like '08, Soros and Buffett made so many because they had the liquidity. They could cherry pick the best deals, and it's so looking. Staying on the investment theme, another place where you have had a lot of experience, inflation, right? And just maybe some just general thoughts, not in terms of predicting what's going to happen, but just in terms of high-level ways that one might handle inflation, or some insights there.
Well, yeah, one thing that, if you're running a pension plan, if you stress test your liabilities, you can really get a good sense of what your inflation exposure is. And, so I would say the biggest three risks in most pension plans are equity market risk, as everybody's aware of. Decline in long-term interest rates is another big risk. It's probably the biggest risk. And unexpected inflation, because most pension funds assume inflation of around 2%. So if it turns out to be 5%, you're going to be underfunded. So, and it's really about wage inflation. So somebody who's 40 years old today is going to retire at 65. You're assuming wages are going to increase by a certain. It's a bit more than the assumption is more than 2 in wage inflation, but say it's 3.5, or if it turns out to be 5. You haven't put enough money aside to meet their pension obligation. And that's sort of the first place it is. And the second place is most funds intend to give cost of living adjustments on pension payments. So it comes into play there as well. So you can figure out, just the exposure you have to inflation. And so you should do what you can to try and hedge it. And it's not that easy. It's part of it is just, part of the reason why you own equities is because you want to earn a high real rate of return to beat inflation. But also, you can own other assets that correlate well with inflation, such as, real estate hasn't turned out that way this time, but generally speaking, real estate is a good hedge for inflation because there's a cost push argument to real estate. Also, commodities have tended to be a pretty reasonable hedge against inflation. People say gold. I don't really see it that way, so I don't see it as a good inflation hedge. But real return bonds is another place for. So real return bonds are a good hedge against the CPI increases you give in pension payments. So it's so real estate actually has in the past has been a good hedge against wage inflation because again, big part of the cost of building a building is wages. So if wage inflation goes up, the cost of building a building goes up, and the rest of the market tends to get repriced to that. So your real estate portfolio tends to go up with wage inflation. Now it hasn't this time because we've had a fundamental change in what's going on. But I would guess if 100 years from now you look back, this will look like a blip. But so generally speaking, real estate's a pretty good hedge for wage inflation.
Fair. Now we started the discussion with culture, and it's been very clear that innovation has been a big part throughout your tenure at Hoop. Looking at today in terms of being able to have success, is one thing, and surviving success. What ideas do you have to maintain or to adapt a culture to keep that culture strong, to keep it where an organization avoids complacency and so forth?
Well, maybe it starts when I used to work for banks. You're as good as your last trade. So if you lost money in your last trade, you may lose your job. So, but it's sort of the idea that you always have to be looking for the next big thing or new thing. And, as new financial products become available, can you adapt to those things? And the markets change, so regulations that other people get are changed, and that may create opportunities for you. I think it's a mentality about always looking for the next thing. And I always tell people that if the organization stands still, the world's going to pass you by. And it goes for you in your personal as well. I mean, I'm a big believer in constant education. So, I mean, if you decide you know it all and you stop learning, I mean, the world's going to pass you by. I mean, that's just the way it is, and it's lots of history of that being true. So, you really have to be always moving forward. So, I also said, I mean, I know 70-year-olds that are younger than people that are 30 years old because the 30-year-olds have stopped learning.
Yes.
And, the 7-year-olds that's still learning, to me, is younger than the 30-year-old.
Fair, definitely. And maybe we'll end with just some, along this last theme, about some words of wisdom to young professionals in the investment arena that you think will serve them well, in addition to continuous learning.
Well, I think if you're just coming into the investment industry, like, try and find something that's relatively new that you can be the expert in, because and I just when I first started, I started working at Merrill Lynch, and so I went in there. I was sitting on the stock desk, and so everybody's either a stock guy or a bond guy, and that was just when equity derivatives were coming on the scene in Canada. So I made myself the expert in stock options, and so if I sat there and I'm going to go up through the bond guys, I mean, I'm going to be the low man on the totem pole and take a long time to work my way up. Whereas if you were the expert in something, all of a sudden you were kind of moved up through the organization pretty fast. So, make people money, they pay attention to it. So, I think that's the bottom line. I mean, you should try and get yourself in a position where it's something new where you can be the expert, and then try to figure out strategies to make money for people. And
nice. That's excellent, and we thank you again. It's been a tremendous honor to have you on this podcast, and thank you.
It was a real pleasure being here. Thanks for having me.